On August 19th, the SEC charged billionaire hedge fund manager Carl Icahn with violating securities laws regarding his investment company Icahn Enterprises, or IEP. IEP is a publicly traded holding company which Icahn invests through, and which allows ordinary investors to invest alongside the Wall Street legend. The charges come a year after famed short-selling research firm Hindenburg published a damning report accusing Icahn of running what they called a Ponzi-like economic structure. While the SEC's charges stopped short of calling IEP a Ponzi scheme, they did accuse him of depriving IEP's shareholders of information about his own actions that greatly increased the risk profile of the stock. In particular, they said that Icahn had used more than half of all outstanding shares of IEP as collateral for billions of dollars worth of personal margin loans. If these loans experienced a margin call, for example due to Icahn's poor investment performance, he may be forced to fire sell those shares, causing the stock price to tank. Icahn and IEP settled with the SEC for millions of dollars, but as of the most recent available financial reports, IEP still appears to be running an unsustainable business model. In this video, we'll examine how the SEC says that Carl Icahn violated securities laws, how much risk this put on unsuspecting investors, and whether IEP's stock is still trading at unsustainable levels. IEP is a holding company that makes investments in various industries. Carl Icahn and his affiliates own about 85% of IEP and control the company and its investments. The 15% of IEP that is not owned by Icahn is publicly traded, and mostly owned by retail investors who are attracted to IEP's large dividend yield. For the past several years, this high dividend yield has allowed IEP to enjoy a stock price valued far above its investment net asset value, or NAV. In fact, while most other similar holding companies run by other famous hedge fund managers like Bill Ackman or Dan Loeb trade at discounts to NAV, IEP currently trades at an 88% premium to its reported NAV. And according to Hindenburg, the reported NAV was itself inflated via questionable valuations of private and illiquid investments. This high stock price provided Carl Icahn with a very lucrative opportunity. He was able to use his 85% ownership stake in the company to take out billions of dollars worth of personal margin loans, with the IEP shares as collateral. From 2018 to 2022, these loans totaled $4 to $5 billion from multiple creditors. For comparison, IEP's current market cap is only about $7.5 billion, and its reported NAV is only $4 billion. If IEP's stock price fell below certain thresholds, it could trigger multi-billion-dollar margin calls. This would likely force Icahn to sell a portion of his shares to raise cash, as according to Forbes, the majority of his net worth was in IEP shares. This sudden selling in IEP shares would likely cause a massive drop in IEP's share price. So just how much risk did these personal margin loans pose to the share price of IEP? It's impossible to say what the exact impact of a potential margin call would ultimately have been on the share price, but at the end of 2022, IEP had a market cap of around $18 billion, about 85% of which was owned by Icahn and his associates. So around $3 billion of IEP was available to trade. But only a very small proportion of this $3 billion actually traded each day. Most of the holders of IEP stock bought it for the high dividend, and thus would not be likely to be trading in and out of the stock very often. Only about 500,000 shares traded hands per day, or about $25 million worth. According to the SEC, Icahn had pledged over 180 million shares to collateralize $5 billion of personal margin loans at the end of 2022. At the $35 per share that IEP was trading at the time, if Icahn sold 20% of the traded volume each day, he would only be able to raise about $5 million per day. That would only account for 0.1% of the principal value of his margin loans. Depending on the specifics of this hypothetical margin call, he might even be forced to sell much more than that, which would certainly tank the stock price. And this hypothetical margin call may have been much closer than you might expect. Over the past several years, Icahn has repeatedly made public bearish statements about the markets, and has accordingly held significant short positions in his own investments. In 2022, he went on Bloomberg saying that he thought the economy was poised for a downturn after too much stimulus from the Fed and a lack of accountability among executives in corporate America.
If you're asking me to predict something, I'm only saying, and it's not saying very much, I guess, that over the next 3-4 years, or maybe a lot sooner, you are going to see this whole thing hit the wall in one way or another, and it's not going to be a pretty outcome.
Since that interview, the overall market has marched to all-time highs, and Icahn's investments have reported continual losses. IEP's annual SEC filings disclose that Icahn's investment funds had a significant net short position on the market. At the end of 2022, it reported a 47% net short notional exposure to the market and a $180 million net loss. By the end of 2023, this short exposure had decreased slightly, but still sat at 36% net short. That year, Icahn's short thesis did not play out, with the S&P 500 finishing up almost 25%. This led to substantial reported investment losses of 16.9% in 2023, driven by an 18.5% loss on its short positions. These losses cost IEP $670 million, or almost 20% of reported NAV. Carl Icahn is best known for his activist campaigns, where he builds a significant stake in a company, then tries to influence the company's decisions. One of his most high-profile recent activist campaigns has been with the gene sequencing company Illumina in early 2023. He wanted the company to drop its bid to acquire a European pharmaceutical company called Grail, which he said was a value-destructive deal. Later that year, he successfully got one of his own directors nominated to Illumina's board, and the CEO of Illumina to resign. Yet despite this, Icahn's campaign largely failed, with Illumina stock having lost almost half its value since he launched it. He seems to have since given up the campaign, as earlier this year he decided not to nominate any of his own directors for seats on Illumina's board. Icahn still owns his shares in the company at over 50% losses. In Hindenburg's short report from last year, they did an analysis of Icahn's investments at the time, and estimated that he lost about $423 million in just the first part of 2023. These losses were largely attributable to Icahn's second largest holding, $2.2 billion in a company called CVR Energy. In the past 2 years, this stock has underperformed the S&P by over 60 percentage points, and as of the most recent available filings at the time of recording this video, Icahn appears to be still holding the stock. Because his margin loans were collateralized by IEP stock, Carl Icahn needed the price of IEP shares to remain high. Hindenburg said that he did this by using a number of shady strategies that they likened to a Ponzi-like economic structure. Central to this strategy was maintaining an unsustainably high dividend payout. The majority of investors in IEP were retail investors, who were attracted to the stock due to its incredibly high dividend yield of 15%. For comparison, all of the companies in the Dow Jones Industrial Average pay dividends of 6% or below, and all but one of the companies in the S&P 500 pay dividends of 8% or below. Yet despite the too good to be true dividend, investors were willing to trust IEP because of Carl Icahn's legendary status on Wall Street. As Hindenburg highlighted, the company was able to pay such a high dividend because it continually issued new shares to support its negative cash flow. Since 2018, IEP's share count has increased from 180 million to 450 million in the most recent quarter, while paying a dividend yield well over 10%. This is what Hindenburg likened to a Ponzi-like economic structure. They would attract new investors into the stock with a high dividend yield, sell shares to them at high prices, and use the proceeds to pay the exorbitant dividend to existing shareholders. As it turns out, IEP's dividend was not sustainable. In the third quarter of 2023, IEP slashed its dividend in half, fulfilling Hindenburg's prediction that the company would have to cut or eliminate its dividend. After the Hindenburg short report and the slashing of the dividend, IEP's share price has lost over half its value and currently trades at around $15 per share. So how has this affected Carl Icahn and his massive margin loans? In July of 2023, Icahn was able to consolidate these loans under a new loan agreement in a clever way. This new loan agreement is still collateralized by 320 million shares of IEP, plus a $2 billion stake in funds managed by IEP. However, it changes the way the value of this collateral is determined. It is no longer calculated based on the stock price of IEP. Now it uses the net asset value of the assets IEP invests in instead. Thus, it no longer benefits Icahn to have an inflated stock price. This is likely a key reason why, that same quarter, IEP slashed its dividend in half. After settling with the SEC in August of this year, Carl Icahn pointed out in a statement to CNBC that the investigation made no claim that IEP engaged in a Ponzi-like structure, or that it inflated the net asset value of its investments. In fact, contrary to the idea of IEP running a Ponzi-like structure, it even authorized a $500 million share buyback in May of 2023. Yet IEP appears to still be an unsustainable operation, even after slashing its dividend in half. As of the most recent data, the company hasn't bought back a single share under this authorization, probably due to the fact that IEP still trades at a significant premium even to its stated NAV. In fact, not only have they not bought back any shares, they sold $100 million of new shares at an at-the-market offering in the first half of 2024. Companies generally buy back stock when they have excess cash and management believes the stock is undervalued, and they issue new stock when they are in need of cash or management believes the stock is overvalued. In IEP's case, they seem to be both in need of cash and have an overvalued stock. IEP remains net short the market despite the market continuing to reach new highs. These investments resulted in another loss of $430 million in the most recent quarter. So what does this all mean for IEP going forward? On the one hand, it continues to make massive investment losses and is hemorrhaging cash. It's paying hundreds of millions of dollars per year on a dividend that is still unsupported by its operating cash flows, and it is obscenely overvalued versus its reported NAV, to say nothing of Hindenburg's allegations of the reported NAV being inflated. On the other hand, investing is a volatile industry. Just as one year's best hedge fund manager could be the next year's worst, it's possible that Carl Icahn could turn things around and start generating positive investment returns again. And in the short term, there's no reason why IEP cannot continue to issue new shares at highly favorable prices to pay a few more dividends. Eventually though, this will stop working, because supporting a high dividend by issuing new equity necessarily implies that the share count will increase exponentially. This cannot last forever. When IEP can no longer support its high dividend yield with new stock issuances, the dividend will have to fall to a sustainable level within the investing gains of IEP's portfolio. Once this happens, there will be nothing supporting its premium to NAV. Since the stock is currently trading at nearly double its reported NAV, it has a long way to fall when this finally happens. Alright guys, that wraps it up for this video. What do you think about Icahn Enterprises? Do you think there's any way for Carl Icahn to turn it around? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next video. Wall Street Millennial, signing out.